So this past year, we've experienced one of the most volatile markets in history, with the tariffs in April causing one of the biggest drops in S&P history. And despite the bull run from April to August, with the government shutdown, rising uncertainty, and conflict, the market has been pretty volatile. And in times like these, it is more important than ever to have protection and insurance against your investments, particularly in the form of a hedge. Now, if you don't know what a hedge is, it is basically a risk management strategy to protect against potential losses. So in today's video, I'll be teaching you guys the 5 methods I will use to hedge against uncertainties in a bear market. Now, I'll be ranking these methods from beginner friendly all the way to advanced, and I will also be ranking these in terms of risk level. Now, before I begin, I must inform you that this is not financial advice. Everything I say in this video is for educational purposes only, and you must always do your own due diligence before making any sort of investment decisions. Alright, I'm not going to waste your time. Let's jump right into it. Now, starting off with number 1, and that is to stay cash. This is the most simple and most basic method to protect yourself in a bear market or recession. Now, the purpose of this is to have optionality and safety. The reason why you want to do this is that you can have liquidity to buy dips in a market downturn. Now, the only trade-off you will have is that if markets do decide to bounce, you'll be staying stagnant. And it is not a coincidence that Warren Buffett had $381 billion sitting in cash reserves last year. Alright, so moving on to number 2, we have selling covered calls. Now, if you don't know what a covered call is, I suggest you go watch my video right here, which will explain to you in more detail what a covered call is, how to sell it, and how to generate income. Now, the purpose of a covered call is to generate income and reduce volatility. But there is one requirement. You must own 100 shares of the underlying stock in order to sell a covered call. So by selling a covered call, you will collect a premium from selling the call. And if the price of the stock expires beneath the strike price of the covered call, you get to keep the premium entirely. However, the trade-off is that on the other side, you will have a capped upside if markets decides to rally. Now, this is one of my favorite strategies because it is low risk and you can repeatedly sell covered calls to generate income even if the stock decides to trade sideways. Alright, so moving on to number 3, we have what's called inverse ETFs. So inverse ETFs, the name pretty much speaks to itself. It moves dollar for dollar directly against the underlying stock or ETF. Now, if you want to be a little bit more aggressive, you can buy what's called a 2x inverse ETF, which will basically mimic the stock's decline but double the percentage. Basically a double short. Now, I prefer to buy inverse ETFs versus shorting because with shorting, the risks are unlimited. The potential losses are unlimited. But with inverse ETFs, just like buying a stock, the most you can lose is as much as you can put in. You cannot lose anything more than your initial investment. But the only trade-off with this one is that you got to be careful with the daily resets, because with the daily resets, they can cause drags and decays over the long term. And it is not advised to be holding these inverse ETFs for months, especially if you're doing the 2x or even 3x leverage ones. Alright, now we're getting to the more advanced ones. So moving on to number 4, we have what's called shorting. Shorting is basically borrowing a stock and selling it immediately so you can buy it back at a lower price and return it back to the lender. However, with shorting comes unlimited risk, like I explained earlier in the video, because theoretically, the stock can rise to infinity and your losses can be substantial and even more than your initial position. This can result in what's called a margin call, which means you owe more to the brokerage than initially you have in your position. And that's not adding on top of the interest rates and margin rates when it comes to different brokers. So for this strategy, I'll be categorizing this as one of the higher risk strategies. Alright, so moving on to number 5, we have what's called a protective put. But this is basically buying a put on a stock you already own. So what this does is that it will create a floor so you know the max loss you would experience. So if the stock decides to decline, the profit you generate on that put will be able to offset the losses you have in your initial stock position. But you must keep in mind to buy longer dated puts because you don't want to be fighting against time decay on top of the already declining stock position. Also, you should not be buying anything more than 1 to 2% of your entire account balance when it comes to puts. Alright, so last but not least, moving on to number 6, we have what's called a short call spread. This is the most advanced and riskiest strategy I use to hedge against a bear market or recession. So what a short call spread basically is that you buy a higher strike call, but you also sell a lower strike call. This way you get to collect a premium immediately, but the upside is capped in a second hedge. If this is getting a little bit more confusing, I suggest you watch my video right here, which will explain to you in more detail what a short call spread is and how to sell it. So I've been experiencing with these advanced credit spread strategies lately, and I gotta say, the short call spread is by far one of my most favorite strategies. I'm starting to like it because of the premium you collect is significantly more than a covered call. However, with that, there's also significantly more at risk and at stake. So the key to selling a good short call spread is to find them with a delta of 0.7 to 0.9. So that way you know there's a 70 to 90% chance of the short call spread expiring in your favor. Hedges are great for defense, but if you guys want to know what specific stocks I'm buying in 2026, go check out the video I'm linking right here. Alright, so now that we're at the end of the video, I hope you guys learned something. Now, last thing I would advise you guys to not do is to try any of these strategies at home have you not fully understood the concepts underneath them. Investment involves significant risk with the potential loss of your entire initial capital. So please, do yourselves a favor by paper trading and experimenting with them first before diving deep into them. Speaking of paper trading, the best platforms I recommend doing them is on Interactive Brokers and Webull. Now, if you guys do decide you want to sign up for Webull, you can use my link in the description below to sign up, which will grant you up to 100 free stocks. I am not sponsored by any of these companies because I'm not that big enough yet. I only have like 200 subscribers. So please, if you guys can do me a favor by going down there and hitting that red subscribe button for me, it would do me wonders. I hope you guys had a great New Year's, and as always, stay safe out there.